Okay, let's get settled in. Okay. Okay, a couple of things. One is there are 3 more sessions left. Last class is a week from today, so you know what's coming next. Right? So I sent you the to-do list on Thursday, and it looks awfully long if you haven't started on it, but it actually goes through it. As you go through and check off each item, it actually passes faster than you think. So if you haven't gotten started, get started. If you've started, keep moving. Try to get all your numbers together by Friday. That's my suggestion, because that'll give you, first it'll allow you to send your summary in to me. If you don't remember what I'm talking about, in the to-do list I said when you get your numbers, it doesn't even have to be as an entire group. If 5 out of 6 of you have your numbers already, and it's summary numbers, what's your optimal debt ratio, what's your actual debt ratio, what do you come up with, please send them to me, because if you get, now I need them by Sunday night, because here's what I do. I pull all the numbers together, and next Monday in class, you're actually going to see what the entire class looks like. You know, what the high optimal was, what the low was, how many companies were under-levered, how many were over-levered, how many had positive Jensen's alphas. But to do that, I really need your numbers. So that's why I'll keep asking you for those summary sheets as you go along. I mean, obviously, you've got to finish your numbers first before you can send them, but once you get them done, then you can start sending them back to me. The other is your quizzes that you haven't picked up are still upstairs. There are about 60 left, so come and pick them up when you get a chance, so that way you'll have all the quizzes. Sometime this week I will send you, information about the review session and the seating for the final. In fact, for the final, we're going to have 260 in this room, so it's a bigger room than the 170, so it's going to be a little more room to sit and spread out. So I'll send you more information on that. Okay? So let's pick up where we left off. We were talking about BP, right? A company that got into a problem of paying too much in dividends and didn't know how to get out. And that's not uncommon. In fact, a lot of oil companies that started paying big dividends 3 years ago, 4 years ago, are going to be in the same position as BP is right now, which is oil prices are down. They can't afford to pay the dividends that they used to. In fact, any time you have a transition in a sector where you go from low growth to high growth or low reinvestment to high reinvestment, this is going to become a problem where your existing dividend policy doesn't fit you as a company. Now, we know intellectually what you have to do as a company, right? You got to cut dividends. But you know what the problem is? When you cut dividends, your stock price is going to drop. You're saying, doesn't it matter why I'm cutting dividends? In fact, this study actually looked at dividend cuts which were accompanied by other news. So the way to read this is the quarter leading up to the dividend cut. This is actually the few days, the 3 days around the dividend cut, and finally the quarter after. So 3 scenarios. One is you have a dividend cut that's accompanied by a drop in earnings. Okay? The second is a dividend cut where there was an earnings drop that was announced a quarter before or 2 quarters before. And the third was a dividend cut accompanied by some kind of explanation that sounds good. No, we're going to do this because we need to reinvest more. Now, as I said, intellectually, the third scenario is the best one for you as an investor. But here's the problem. As an investor, what do you see? You see the company cutting dividends, right? What does the company tell you? We're doing it for good reasons. We're doing it because we have projects. But a part of you says, how do we know? How do I know you're not lying? I mean, as investors, you got to listen to what companies are saying, but you also have to recognize a lot of companies shade the truth. They might not lie. So initially when it happens, guess what? For all 3 scenarios, whether it's accompanied by just an earnings cut, by a prior earnings cut, or an investment opportunity, there's a stock price drop. So if you're a company and you're the CFO of a company or CEO of a company and you decide to do the right thing, cut dividends, don't expect glory right off the top. Your stock price will drop on the announcement because people just don't know why you're cutting dividends. But here's the good news. If you follow through and look at the quarter after, assuming that your dividend cut wasn't precipitated by some really bad news, bad earnings drops, your stock price recovers. Maybe not in every company, but on average it does. All I'm saying is if you have a dividend problem, you have to fix it early. You have to do it when you control the agenda. You know what I mean by you controlling the agenda? You have enough leeway to cut the dividend and manage the consequences, as opposed to what happened at BP. You know why BP cut dividends? For those 9 out of 10 years, where did they go to get the cash to pay the dividends? They went to the bank and borrowed $1 billion, right? In 1992, they cut dividends not because it was the right thing to do, not because they looked at the free cash flow equity and said, we can't afford to keep paying dividends. They cut dividends because when they went to the bank to borrow money, the bank said, hey, no more, you're already the most highly levered oil company in the world. The decision was taken out of their hands. If you're forced to deal with the dividend problem by the market, it's a much more serious problem. So that's an old-time company that starts paying dividends. It has to change. Let me give you a fourth scenario, fourth example. And this is actually for the Limited in the 1980s. The Limited was a big high-growth retail chain in the 1980s. In fact, the Gap and the Limited were the big growing retail stores of the 80s. So this is actually free cash flow equity and dividends for the Limited from 1983 to 92. I've taken a 10-year period. Now, notice for all these companies, I am looking at a 5 or a 10-year period because looking at 1 year can give you strange numbers. Over the 10 years, the average free cash flow equity, the Limited, was minus $34.2 million. Let me pause and ask you a question. It's a very, very straightforward question. There are no tricks. If a company has negative free cash flows to equity, how much can it afford to pay in dividends? Nothing. But they managed to pay $41 million. And this is in spite of the fact that they had great investment opportunities, they had growth, they had great returns on equity, they were paying dividends. So why does this happen? And again, this is not unusual. And I'll give you the story that probably got them started. I'm not sure that this is the story, but I think this might have been why they got started. You're the Limited. It's 1983. You're a young growth company. I'm your investment banker. I show up and say, look, if you don't pay dividends, there are some investors who cannot hold your stock. Is that true? Yeah, there are some investors who can't. For instance, there are some pension funds that are restricted from investing in companies that don't pay dividends. So far, so good, right? So here's what I suggest to you. Why don't you pay a token dividend? I know you have a negative cash flow equity, but just pay a small dividend. Sounds like a great idea, right? Because here's how the reasoning goes. You pay a small dividend, what happens? You get on that buy list for all these companies that otherwise couldn't have bought your shares. The demand for your shares goes up. The price will go up. I think it's horrible advice. Why? If I'm thinking it, I should tell you, but you probably can guess why. Why is it bad advice to tell a company with negative free cash flow equity to pay a token dividend? Do you remember how I described the investors in BP? What did I call them? Dividend addicts. Have you ever tried offering an addict a token? Have a little cocaine, but stop now, please. It doesn't usually work. You offer an addict a little, what do they want next? They want more. So you invite these people who like dividends and you offer them a token dividend. Guess what they'll ask for more of next year? More dividends. If you can't afford to pay dividends, don't invite those people into your room. There are plenty of other investors in the market. Don't go looking for trouble. So if somebody tells you, well, why don't you just pay a little dividend? You'll attract all these pension funds. You don't want them as investors in your company. And you have to be very careful about who you invite as a dividend clientele if you can't afford to service what they will ask of you in the future. So if you can afford to pay dividends, of course, pay dividends. But if you cannot, don't get started on a problem that will only get bigger over time. So if any of you are working with growth companies and you have negative free cash flows equity and you see dividends being paid, even if these are small dividends, you know it's not a good idea. And the sooner you stop the problem from continuing to grow, the easier it is going to be for you to deal with the problem. Which brings me to my fifth and final example. I looked at Tata Motors. Remember, it's a family group company, right? I looked at their net income, their dividend, their payout ratio. If you look at their free cash flow equity, before debt payments, it was minus 106 million rupees, or billion rupees, okay? If I use the actual debt, the fact that this service debt, they had more free cash flow equity, but no matter how you define it, if you look at their dividends, a cash payout as a percentage of the free cash flow equity is 157%. Again, a company that's paying out more in dividends. You think, isn't this like BP? Here's the difference though. It's part of a family group of companies, right? It borrowed too much money. It's now paying too much in dividends. But you cannot think of this company as a standalone company because who knows where those dividends are going. They might be going to other Tata companies that have investment opportunities. Again, it's very difficult to pass a judgment on a company like Tata Motors simply because you don't know what the family group's intentions are. For any of you working with family group companies, if you notice strange things happening in your company, big debt ratios, no dividends, big dividends, remember that that might be because of intra-group requirements on what capital you need. So when you look at your company, look at what it can afford to pay out, that free cash flow equity. It's not complicated. You just have to work through the statement of cash flows, figure out what could my company have paid out. Not just in 1 year, but over 3, 4, 5 years. Of course, if you have a company that's been around only 2 years, you have no choice but look at only 2 years. But if you have more time, look at it across time. Because your free cash flows equity will go up and down. Look at what they actually return to their investors and then say, is this the kind of company I would put pressure on to give more cash back? Or is this the kind of company that should be cutting back how much it returns to its investors? Any questions on dividend policy? Yeah.
Is the free cash flow to equity pre-debt just the free cash flow to the firm?
I'll tell you why I compute 3 different free cash flows equity. It sounds confusing. One of the things that debt does is when you borrow money, what happens? Cash comes into the company, right? So if over the last 10 years you've been borrowing a lot of money, your free cash flows equity can be nice, big, positive numbers. You think, I can afford to pay dividends. But you should be a little queasy about the fact that you're paying dividends not because your operations are throwing off cash flows, but because it doesn't mean it's a bad thing. It means that you cannot keep doing this in the future. So that's why I give you all 3. Is the free cash flow equity pre-debt comes directly from your operations. You can keep paying that kind of dividend even if you don't borrow money in the future. The free cash flow equity with a target debt ratio is a little more sustainable because you say, look, if I have a target debt ratio of 10%, then I can keep paying the dividends. The free cash flow equity is actual debt you've got to be very careful with because if it's a period where you borrowed a lot of money to get up to a high debt ratio, you can't keep doing that. So one is more, so 3 levels of sustainability. Free cash flow equity, net debt, before debt is the most sustainable number. The second most sustainable is with the target debt ratio. The one with the actual debt you've got to take with a grain of salt because it depends on what your company did over that period. Okay? Any other questions? So put your companies, when you're all ready, you got these numbers for your 5, 6, 7 companies in your group, put them on the matrix. With my companies, here's what they look like on the matrix. If you remember the matrix, on one axis I have good projects and bad projects. On the other axis I have whether you're paying out less than you can afford to or more. Baidu, for instance, is earning well above its cost of capital and it's paying out much less. It's in fact paying no dividends, buying back no stock. But I'm okay with that. If I'm a Baidu stockholder, I'm okay with the cash accumulating in the company because they've taken good projects and delivered good returns for me as a stockholder. So it's up there. Disney actually pays out more in cash than it can afford to, primarily because of its big stock buybacks. Its projects are good because it earns more than the cost of capital. It's slightly below the line, not hugely below the line, but it's a company where you got to stop and ask, maybe you should be cutting back on your stock buybacks because if you have good projects, this might not be sustainable. Vale and Tata Motors are problematic. Their free cash flow equity is well below their dividends, and both of them I think are trapped by history. Tata Motors because it's historically always paid big dividends and continues to pay it to its group companies. Vale because of its history of control where it had preferred and common shares. I think until you deal with those underlying problems, they're going to keep going. And finally, Deutsche is paying out more than it can afford to, but its projects are not good either. So this is a case where you say, look, maybe if they fix their operations, if they start making a return on equity that's more reasonable, the problem will go away. But that's the advantage of the matrix. You can compare companies within a group to see where they fall and give some companies flexibility. In other companies, you pull the strings and say you need to return your cash back to your stockholders. Okay? So that's almost an intrinsic way of thinking about dividends. If you get a chance, do it for your, let me take out the if you get a chance. You have to do it anyway by next week. So do it, as soon as you can. Get your free cash flows to equity, get the dividends, check the signs on your cash flows to make sure you're not flipping the cash flows. Take 1 year and see if you can intuitively work out what's going on, because that's a good way to understand this process. And then decide which companies, if you were an activist investor, if you were a Carl Icahn, which of your 5 or 6 companies would you be putting pressure on to give more cash back to stockholders? So that's the first way of assessing dividends. It's almost like the cost of capital approach for capital structure. It's an intrinsic assessment of whether you can pay as much as you can in dividends. What's the other way in which companies set dividend policy? They look at everybody else in the sector and try to decide what's right for them, right? So let's try this approach, and it's not complicated. Basically what you do is you look at your peer group, and I'm going to put quotes around the word peer because what you call your peer group and what I call can be very different. So with my companies, here's what I did. I took my 5 companies, I looked at their dividend yield and dividend payout, and I went back to conventional dividends, right? And I actually have a different table if I include stock buybacks as well. And for the comparable companies, for Disney, I looked at US entertainment companies. For Vale, I looked at global diversified large metal and mining companies. For Tata Motors, I looked at global automobile companies. For Baidu, global online advertising, and Deutsche European banks. Again, subjective judgments I made. I looked at the average dividend yield and payout ratio by sector. So let's pause right there. If I gave you Disney and said, what do you think of Disney's dividend yield and payout? You can compare its dividend yield, 1.09 to 0.96%, pretty close. And its payout ratio is actually slightly lower than the sector. So it looks very much like the sector in terms of what it does. Vale has a dividend yield and a payout ratio that looked odd, but if you looked at the sector, guess what? They're all odd, and that's one of the problems with being like the rest of the sectors. If everybody's doing strange things, you're also going to do strange things. Tata Motors actually stands out because it looks like it's paying less than the comparable companies in dividends. Baidu pays no dividends, but it's in a sector where nobody pays dividends. And finally, if you look at Deutsche, numbers look strange, high dividend yield and high payout ratio, but it's in a sector where both those numbers are also high. The point I'm making is most companies, when you think about why they do what they do, why they pay out what they pay out, often the answer is look at the other companies in the sector and you'll have a pretty good sense of what gets them started. Okay? Now a little deeper look at the entertainment sector, which is what I use for Disney. The problem with Disney and the entertainment sector is if you take out Disney and Time Warner from the US entertainment sector, you have a lot of small entertainment companies. So basically for Disney, I looked at dividends and buybacks, and I looked at it across the sector. Right? So I've included both the traditional dividends and I've also included dividends and buybacks. If you look at Disney on traditional dividends, it actually looks like it's on par with dividend yield, but in terms of payout ratio, it's much lower. But if you include the stock buybacks, Disney is returning a lot more cash than the typical entertainment company. And that's going to be the case with many of your companies. When you compare to the rest of the sector, you can say on the one hand, on the other hand, no. So here's how I'm going to try to break the tie. I have the data for the entire sector. I have the yields and payout ratios. I essentially looked at, initially I'm going to look at all US companies, and I'm going to look at the sector. I looked across all US companies on terms of dividend payout and dividend yield. So the thousands of companies in my database. Basically the question I'm trying to answer is, given how other US companies are paying dividends, does Disney look strange? So that's what my regression looks like. You're probably not impressed with the R squared, 20% and 26%. But that's pretty much all I can explain if I try to explain dividend policy across the entire market. There's a lot of stuff going on that it's unexplainable. Right? So basically the variables I used was beta to capture the risk of the company. I assumed that higher risk companies would pay out less in dividends. Earnings growth, because high growth companies should pay out less in dividends. I also looked at the debt ratio because the debt ratio stands in as a proxy, and in this case actually the higher the debt ratio of a company, the more dividends it tends to pay out. Partly because of that agency issue, you've got to pay out more because you've borrowed more money, and partly because you have cash coming in from debt. And finally, I run the regression. These are the T statistics right there, and all of them are big. I mean, remember the cutoff for a T is about 2. These are all 10, 12, 15, so they're all statistically significant. Actually, I have to tell you, when I ran this regression, I started with 11 variables and I started lopping off the ones that were not statistically significant. So this is the best of the regressions I could come up with for dividend policy. But it brings home the point that differences in dividends across companies are often very difficult to explain using fundamentals. Okay? I plug the numbers in for Disney into those regressions. So basically I use the beta of 1, the bottom-up beta, the expected growth, and the market debt to cap ratio. And I came up with predicted dividend yields and payout ratios for Disney. The way to read those is, given how other U.S. companies are paying dividends, Disney's dividend yield should be about 1.4%. Its payout ratio should be about 27%. It's slightly below both those numbers. But that's just looking at traditional dividends. I tried this regression using cash return, which includes buybacks. The R-squares just fell through the floor. It's almost impossible to explain those ratios because they tend to jump around year to year. But it's again a way of stepping back and saying, let's look at how the rest of the sector behaves, and let's see if I can explain how my company pays dividends based on the rest of the sector. Now, when you do your company, you don't have to run regression, so don't get too carried away on this. But take a look at the rest of the sector, either by, in fact, if you did your bottom-up beta, you had a set of companies you pulled up for your bottom-up beta, take the same companies and look at the payout ratio and dividend yield. At least get a sense of, how does my company look relative to the other companies in there? The market regression that you saw on the previous page, I have the updated version of that on my website. So if you just want to plug and chug and see what you get, you might never use it, go ahead and use it and see what you can get as your predicted dividend yield and your predicted payout ratio. So that's dividend. Any questions at all about dividends? Okay. Let's get to the last and final piece of this class. The two classes I teach I think of as bookends. Okay? So the corporate finance class ends with valuation. The valuation class picks up with corporate finance. And they're bookends, and if I were asked to describe the two classes, here's how I describe them. In corporate finance, I look at companies from the inside out, right? Investment policy, capital structure, dividend policy. In the valuation class, I look at those companies from the outside in. You know what I mean by the outside in? I'm an investor looking at Disney. I actually get a lot less freedom in my valuation class because as an investor, I can't sit there saying, I'll change the debt ratio. It's not my company. So when you do valuation, at least you're looking at these companies almost as onlookers. But the process by which I think about value remains exactly the same, whether I'm on the inside looking out or the outside looking in. So one of the things you're going to notice in this section, which is kind of a compressed version of the valuation class, is you're going to see a lot of familiar numbers. Familiar numbers that we used in corporate finance are going to come back in the process of valuing a company. Now, as I get started here, I also have to tell you that how many of you worked in investment banks before you came here? Okay. Much of what passes, or consulting firms, any place that talks about valuation, much of what passes for valuation out there is pricing. Let me draw the distinction. I know most of you don't own your apartments. Does anybody here own their apartments or houses? Okay. So when you went looking for an apartment, you hired a realtor, I assume, right? Yes. And the realtor showed you 4 or 5 apartments, and right after they showed you the apartment, they named a number. How did the realtor come up with that number? What did they do?
Well, the number was the number that was already posted on the listing.
But how did the listing realtor come up with that number? Basically, they looked at other properties that had sold in the neighborhood, and they came up with a number. That's pricing. They didn't do a discounted cash flow valuation of the apartment, say, you know what the cash flows are. So that's pricing. And let's make this a little more complicated. Let's say you have 2 commercial properties. One is 100,000 square feet and the other is 1,000,000 square feet right next to each other. I can't compare the numbers because one is much bigger than the other, right? So what do they do in real estate to try to control for the difference? What do they? They divide the price per square foot and say on a square foot basis, this is cheaper than this, still pricing. You're saying those unsophisticated realtors. Pick up an equity research report. Right? You'll see a company, you'll see an equity research analyst's name, you'll see a multiple. Sounds fancy, but that's like a price per square foot, right? Price by earnings, price EV to EBITDA. And then what else do you see? You see 15 other companies that the analyst claims are comparable to this company. Now let's compare the two. The realtor came up with the price for your house based on 6 houses in the neighborhood that had sold recently. The equity research analyst is taking Microsoft and has claimed to have discovered 12 companies just like Microsoft as comparable companies. Who do you think is on more reliable ground? The realtor when he or she says, I found 6 properties in the neighborhood, or the equity research analyst who says, I found a dozen companies just like yours? I'll trust the realtor every single time. Much of what passes for valuation is pricing. That's what, if you use a multiple in comparables, your pricing, nothing wrong with that, because if your job, why do realtors price? Because they've got to sell. They can't tell you the intrinsic value of housing is slow now, we won't sell for the next 3 years. You won't be a realtor for very long. Your job is to not tell me what the intrinsic value of an apartment in New York City is. It's to tell me what the price is. It's what works for both of us. I want to buy something today. You want to sell something today. You price the damn thing. You don't value it. And 90% of valuation is done for selling. Somebody's selling something to somebody. It's pricing. Again, I'm not saying it's a bad thing, but it's not valuation. We won't get much of a chance to talk about pricing in this class. I want to talk about valuation because it's more closely connected to corporate finance, but we spend a big chunk of the valuation class talking about how do we price things better. Because let's face it, your job might require you to price things, not to value them. But it's an insight that will actually give you some comfort when you think about why do bankers do what they do. So the next time you see an IPO and you see a number attached to the IPO, don't assume that a banker went through a discounted cash flow model and actually valued Twitter or Box or Shake Shack. They've priced it. Of course, they now have to make it look like they're valued, and that's the delusion I don't like. If you price something, just price the damn thing. Don't give me a discounted cash flow model, reverse engineered to give a number you came up with based on the pricing to make it look like you valued something, because that's how we get into trouble. So I'm going to dance this dance between value and price, because much of what we talk about in corporate finance is valuation. It's about connecting, maximize the value of the company, not maximize the price of the company. And that can lead to a conflict. What can make your price go up versus what will make your value go up. So let's start this process off by looking at where we're back to. We finished all 3 principles: the investment decision, the financing decision, the dividend decision. In the investment decision, we said go out and pick investments that earn a return greater than the minimum acceptable hurdle rate. In the financing decision, we said find the mix of debt and equity that minimizes that hurdle rate and match the debt up to your assets. And the dividend principle, we said if you cannot find investments that earn the hurdle rate, take the cash out of the business. But in doing all of this, we said the objective is to maximize value. So I'm going to go back to that core word, value, and try to connect it to everything we've done in this class. And as I said, I'm going to set the table here, because there are 3 basic ways in which you can approach putting a number on a company. The first is intrinsic valuation, which is basically connecting cash flows and risk and growth to the value of the company. Classic, in its classic form, it takes the form of a discounted cash flow valuation, but it doesn't have to be. So in intrinsic value, you value an asset based on its characteristics. In relative valuation, you're pricing the asset based on how similar assets are being priced out there. And finally, there are elements of value where optionality comes in. We talked about this very briefly when we talked about projects. I'll give you an example. Last week, Tesla made a pretty big announcement, right? What did they say they were going to do? They're going to produce a battery that's going to power homes. Right now, it's probably not viable for 99% of the homes out there. But a year ago, I valued Tesla as an automobile company. Today, I would continue to value it primarily as an automobile company, but there's an option embedded in Tesla. What's the option? The utility market, the power market, is a huge market. It might be a very different market from the automobile market. You might think the odds of them succeeding there are small, but there's an option in Tesla that is going to add on to the value that I got last year. In fact, I'm going to do a valuation next week where I'm going to come up with an intrinsic value for Tesla based on the automobile business, And then on top of that, I'm going to try to estimate how much of a premium. And it's not going to be 100%, but it might be a 10% premium or a 15% premium because they've opened up this new market. I'll give you another example. Last September, Apple made two big announcements, two new products. One was, of course, the iWatch. The other was Apple Pay. The iWatch is a more conventional business. If I value Apple today, I've got to bring in the expected revenues from the iWatch, the margins, the cash flows. But when you're a $750 billion company, it is going to make a relative. So I'm not that excited about the iWatch suddenly causing a breakout in Apple's valuation. It could cause the value to go from 130 to 140, but it's not going to make it go from 130 to 250. The Apple Pay, though, is a very different animal. Right now, Apple makes no money on Apple Pay. It probably will make no money for the foreseeable future. It'll probably be a subsidized product, but it's an immense market. What market am I talking about? It's a financial payment processing market, right? If you think about the way we pay for stuff, it is primitive. You order something and then you pull your wallet out, and then you take a physical card out. The cashier runs the card through that thing, throws the cash receipt over her shoulder. God only knows where it lands. This is a recipe for a disaster waiting to happen, and it happens every day to most of us in some way or the other. It's a huge market, extremely inefficiently run right now. And that's a market that Apple has worked on before, right? It's a music business. If you think about it 20 years ago, it was an incredibly inefficient business. The way Apple got in was it like a camel in a tent. It stuck its head under the tent and said, we'll just do iTunes, we'll just take a little bit of your... And initially the music companies thought that iTunes was going to work for them, right? And they discovered 4 years later that they were working for iTunes. Apple Pay, if I were a payment processing company, a credit card company, this is the thing that you have to think about. There's disruption coming. I'm not saying Apple's going to be the one that succeeds, but for me that's an optionality with Apple. That again, I'm not saying it's going to add $100 per share, but could add $15, $20 per share because the potential market is so large. So even though we won't get a chance to talk about it, you can start thinking about scenarios where that optionality is going to kick in. I'll give you one final example. We're going to value Vale, mining company, right? We're going to project cash flows. We're going to take the present value. But we're valuing Vale when iron ore prices are at a 10-year low. And Vale has a lot of undeveloped reserves. When you have undeveloped reserves as a natural resource company, you have the right to develop those reserves, not an obligation, right? So right now it will make no sense for them to go develop all those reserves because iron ore prices are incredibly low. But you know where the optionality kicks in? If iron ore prices go back up, and you're saying there's no guarantee, there are no guarantees anything will happen. But if it does happen, there's an optionality here, which effectively means that when I value Vale using a traditional discounted cash flow model, I'm going to undervalue the company. In fact, I'll say that across the board, commodity companies tend to be undervalued on a traditional DCF basis. Because in a traditional DCF basis, we act as if the amount of oil, the amount of coal, the amount of iron ore that you produce is predestined, but it's not. You get to observe the price and then decide. That's what we mean by bringing an optionality. Again, this class is not the right forum for this, but in fact, in my valuation class, that's what we're talking about in class right now, is applying those option pricing models to add a premium to a young growth company, a premium to a company like Tesla or Apple, or a premium to a natural resource company because of that optionality. So let's think about how discounted cash flow valuation allows us to put numbers. When you think about what drives the value of a company, you tend to think of models and numbers. And here's the other thing I want to bring home. Valuation starts with a story. You know what I mean by a story? To value a company, you have to tell me a story about what you think this company will evolve like in the future. It can't be a fairy tale, right? And some people get carried off into fantasy. It has to be a story that's bounded by the world you live in, not the world you wished you lived in. The world you live in, you got to obey the laws of economics. You have to understand there's competition. You've got to understand all the things that you operate under, but you could tell me a story. To me, all good valuations start with a story that actually makes sense. And the way I think about valuation is my job is to put numbers on your story. Or your job, if you're valuing the company, is to put numbers on your story. I'll give you an example, which in fact I did a session for the AIMRC, the parent company for the CFA last year, where I talked about this connection between stories and numbers. And I started by showing them an evaluation I did of Amazon. So I showed them the numbers, revenues and margins. And if you look at the model, it looks like it's the numbers driving the valuation. But here's the story I was telling about Amazon that drove my value. I'll give you the end game. I came up with a value of about $200 per share for Amazon. The stock's trading at $420. But here's the story I told about Amazon. I saw Amazon as a company that would continue to grow. It's already the third largest retailer in the world. I saw them continuing to grow their revenues at 15 to 20%, which is an incredible growth rate given their size. But the way they were going to do it is by giving away stuff at cost, which is what they're doing right now. If you think about all the Amazon products, Amazon Prime, you know how much each Prime member costs Amazon? $399. You know how much they charge for Amazon Prime? $99. You take product by product. Amazon, what is the phone that they came up with, that they ultimately ended up giving away? Everything. This is not by accident. Clearly Amazon says, we don't care about making money now. We just want your business. It's very tough to compete if you're J.C. Penney against that. But it's by design. They're going to go for high revenue growth with very low or close to zero margins. But here's how I saw the rest of the story evolving. I saw them eventually getting to a point in the market where they can start to use their market power. And here's a scary thought. They drive out the rest of the competition. There are only 3 players left in the game: Walmart, Target, and Amazon. You're now addicted to Amazon Prime. My family is. Okay? My kids just get on there, order everything, Prime delivered. Next day I look at the bill and say, what the heck is that? Okay? I have to get them off as soon as I can. I change my password every 2 weeks to get it. Okay? But here's how I see them doing it. At some point in time, they will start raising prices when you have no place left to go. And the question is, how does the rest of the story evolve? If you're a conspiratorial in nature, how do you see the rest of the story evolving? They're going to keep raising prices to $800, $900, $1,000, and you'll have no place to go, in which case their margins are going to shoot to 15% and they're worth $600 per share. It could be. I'm not saying it's not a viable story. So if your story is Amazon will rule the world and then charge us whatever it wants, it's going to show up as high revenue growth and margins of about 14 or 15%, and the value is going to be $600. In my story, I don't see that happening, and here's why. I see Amazon driving out JCPenney and Radio Shack. They're already out of the, Staples is going to be next. Best Buy will be down the block. But the problem in this business is you can drive out your competition, but you know what you can't do? You can't stop new players from entering. And in my game, I see them driving out their existing competition, but I see new competition from Zappos and other competitors entering, keeping margins. So they will make money. But in my narrative, their end game, they're going to make margins roughly equal to what retailing collectively makes right now, which is about 6%. So in my valuation, what you will see is high revenue growth, and then you'll see margins being very low for the first 5 years and rising up to 6%, and you'll see an end value of $200. And that reflects my story. So if you came to me and said, no, I don't like your numbers, you know the question I'm going to ask you is, what's your story? Because it's not the numbers you disagree with, it's my narrative. So if you disagree with the narrative, if you feel you have a different story to tell, my job is to take your story and find a number to reflect that story. Valuation is about storytelling first and number crunching afterwards. I'll give you a preview. And you get to if you get to my valuation class, then you might decide after this, never again. Okay? No more emails from this guy. That's fine. If you get to my valuation class, I'll tell you what my end game is. Are you naturally, start thinking about this, are you naturally a numbers person or a story person? I'm going to give you a second to think about it. Because most of you know that already. Because one or the other comes natural. I'll tell you what I am. I'm naturally a numbers person. I hated history. 7th grade, I knew this wasn't for me. I had literature class where they look for hidden meanings and all. I just didn't get it. It just didn't make any sense to me. Algebra I loved. There was an answer. I could check it, double check it, reverse check it. No, I couldn't go ask Shakespeare, what exactly were you thinking about when you wrote Hamlet? So I knew early on that the storytelling classes, get to business school, the strategy class, a lot of storytelling, didn't fit for me. So I'm naturally a number cruncher, which means my weakness is the story side. Some of you are naturally storytellers. So if you're a history major, thank you. We need storytellers too. But your weak link is numbers. And in valuation, here's the end game. If you're a number cruncher, you need to be a number cruncher with enough imagination that you can start to think about a story. And if you're a storyteller, you need enough discipline, and that comes from the numbers. So that's what valuation does. It gives discipline to storytellers and imagination to number crunchers. If you have no imagination, be an accountant. You don't need imagination. Balance the balance sheet, you're done. An imaginative balance sheet is not a very good balance sheet, right? That's fine. There's an entire group of people out there without imagination, pure number crunchers. Well, they let them do actuaries, accountants. I mean, it's all those jobs. If you're doing valuation, though, you need to build on both skills. And that's the skill I've had to work on, is the storytelling skill. So as I go through the valuations, that's what I'm going to try to do, is take the story and think about a number to attach it to. And to me, discounted cash flow valuations are ways in which I can bring in all aspects of the story into my numbers. So here are the 4 pieces. When I look at a company, remember I broke the company down into assets in place and growth assets way back in time in a financial balance sheet. The cash flows from existing assets start off my valuation. So that's where I look at the existing 10K, the existing balance sheet, the existing statement of cash flows. It gets me started, but it's not the end game. The second piece of my valuation is how much value am I going to get from future growth? That shows up in 2 places. One is in the growth rate that I use to get your revenues and earnings over time. The second is in what I ask you to reinvest to get that growth rate. One of the things I hope to show is growth by itself is neither here nor there. It could add value. It could do nothing for value. It could destroy value. In my valuation, I have the levers that determine whether for your company growth is going to be value creating, value destructive, or value neutral. Do you see what I mean by value neutral? Growth has a good side, right? It makes your earnings get much bigger or revenues get much bigger over time. Growth has a bad side, which is you've got to put money back into the company to get that growth. The net effect is what's going to drive the value of growth. So my existing financials give me my starting point for cash flows. The value of growth comes from what I assume about future growth and the reinvestment that goes with future growth. The risk in the investment comes from what I see in the company's business, how much it varies over time, what causes it to vary, and it shows up in the discount rate. Everything has its place in valuation. Okay? Yesterday I got a question from somebody in my valuation class who went to an interview. And he must have mentioned that he did DCF valuations. And his interviewer asked him, well, why do you do DCF valuations? You don't know what the cash flows will be in the future. And that floored him. Because that's true, right? You don't know. So he said, what do I say? He said, it's too late. The interview's over. But maybe you should email him back saying, if I knew what the cash flows were in the future, I would do a DCF valuation. Remember, discount rate would be the risk-free rate. The fact that you don't know doesn't mean you can't expect. I know I'm going to be wrong on every single cash flow, but I'm okay with it. I'm okay with it because my discount rate is my vehicle for saying this is how uncertain I am about my expected cash flows, and this is what I'm going to reflect in the discount rate. Don't put the onus of being precise and certain on your shoulders. You cannot be. There's too much that's out of your control. And finally, you can't keep doing this forever. Why? Well, think of your Excel spreadsheet. I think you run out of columns about 16,458 or whatever it is. But you're going to run out of patience well before that. So in valuation, you're constantly looking for, can I stop now? Can I stop now? How about right now? And you ask me, can I stop now? The answer is actually very simple. You can stop if you're willing to assume that at some point in time in the future, your cash flows will grow at a constant rate forever. What does that buy you? When you have cash flows growing at a constant rate forever, what kind of cash flow do you have? A growing perpetuity. When you have a growing perpetuity, mathematicians 200 years ago already have solved for the value of a growing perpetuity is, I'm going to steal from them, and that allows me to stop and say I'm done. So the four pieces in your valuation, cash flows from existing assets, growth, risk, and closure, they all end up in that DCF valuation. So the next time you see a DCF valuation, that's the question you're asking is, where are the cash flows from existing assets? What's the value of growth? Where is risk showing up, and what's driving this closure? So with that framework, let's think about the two basic ways you can approach valuation. Again, let me go back to that financial balance sheet. You have assets in place and growth assets on one side and debt and equity on the other, right? There are two ways you can approach valuation. The first is you can try to value just the equity in a business. So you guys be equity investors, you guys be lenders. I'm going to focus just on the equity investors. If I'm focusing on valuing equity and that's all I care about, then the cash flows I should be looking at are cash flows you get as equity investors. And we'll come back and try to nail that down, but that's my cash flow. And if that is the cash flow I'm focused on, the discount rate I should be applying is the rate of return you as equity investors demanded for investing in the equity. Is that familiar? Because when we came up with the cost of equity in corporate finance, that's exactly how we described it. It's what equity investors demand for investing the equity. Cash flows to equity discounted at the cost of equity gives me the value of equity in a business. Now, if this is a publicly traded company, you're equity investors. Technically, there's only one cash flow you actually see as an equity investor, right? What's your only cash flow which is actually a tangible cash flow that you can point to? Dividends. The dividend discount model is a special case of an equity valuation model. It's a special case because you're counting what you actually get paid. But you can also see it's a very limiting model. Why? The dividend policy section, what did we compute? We computed dividends and we computed potential dividends, right? We know that companies don't pay out what they can afford to in dividends. How do we know? Just look at their damn cash balances. You have $150 billion in cash. I know you're not paying out what you can afford to in dividends. If I value Apple using a dividend discount model, I know what I'm going to find, which is Apple's worth about $25 per share. No surprise, right? Because if they hold back cash, that's what I'm going to focus on. So the dividend discount model is a very special case of an equity valuation model. It's a good place to start because it gives you the starting metrics. But you can very quickly adapt the dividend discount model by replacing the dividend with the potential dividends. If I took Apple and instead of using the actual dividend paid, use the free cash flow equity. That's the other advantage of doing the free cash flow equity. I still have an equity valuation model, but now I'm discounting the potential dividend rather than the actual dividend. I should get much closer to the true value of equity in the company because I'm no longer constrained by the fact that the company might not be paying out what it can afford to pay out. But both equity valuation models, because I'm focused on what equity investors get and looking at the rate of return equity investors demand. That's a natural way to think about investing in a stock. But let's step back and think about the other player in this game. You've got lenders, right? If I start a business, I raise money from equity, I raise money from debt. I start the business does well, I start returning cash flows, right? The first claim on the cash flows goes to the lenders, they get interest payments and principal payments. It's what's left over that you got as equity investors. That's what the free cash flow equity was. So here's the second way to think about valuation. Rather than valuing just the equity, what if I value the entire business? See what I mean by the entire business? I'm going to look at the cash flows you get, which is cash flows to equity, and the cash flows you get, which is interest and principal payments. I'm going to add them up. That's called the cash flow to the firm. It's a pre-debt cash flow because I'm no longer looking at the lenders as outsiders. I'm looking at them as people who supply capital. So I'm looking at a collective cash flow. It's called the free cash flow to the firm. And if that is the cash flow I'm discounting, the discount rate I should use should be a weighted average of what you want, which is the cost of equity, and what the lenders want, which is the cost of debt, which of course is the cost of capital. I told you numbers we see all the time in corporate finance are going to revisit you. Yeah? Basically, cash flows to the business discounted at the cost of capital gives me the value of the business. You will be amazed at how many valuations I see coming from big name companies that mix and match cash flows and discount rates. You know what I mean by mix and match? They will take cash flows to equity and discount at the cost of capital. Cash flows to the firm and they're incredibly casual about cash flows and discount rates. Please don't do that because that's how you can make multi-billion-dollar mistakes. If that's your end game, go ahead and do it. But if you mismatch cash flows and discount rates, strange things are going to happen in your valuation. So you tell me how you compute cash flows. I can tell you what discount rate matches. In fact, let's take the consistency point of one step further. Many companies have a choice of which currency I estimate cash flows in, right? So if I took Tata Motors, I can estimate the cash flows in Indian rupees, I can estimate the cash flows in euros, I can estimate them in US dollars. You see why that matters? If my cash flows are estimated in US dollars, my discount rate also has to be in US dollars. Consistency is perhaps the most critical ingredient in getting a valuation to make sense. Is make sure your discount rates and cash flows are to the same claim holders in the same currency, and if you're going to do things in real terms rather than nominal terms, make them both real. So one of the first decisions you will have to make on your company, and I'm going to take this decision out of your hands because I recognize that this comes in at the end of a long class, so I don't expect you to kind of bring the full ammunition into valuation. But I'm going to give you how to decide when you're sitting down to value a company whether to value equity or value the entire business. Free cash flow is equity, if you remember how they're computed. It's net income plus depreciation minus capex minus change in working capital plus new debt issues minus debt repayments. So it's after debt payments. If you have a stable debt ratio of 10 or 15%, you're willing to assume it stays stable, free cash flow to equity becomes much simpler to compute, right? Because all you do is you take the equity portion of your net capex and the equity portion of the working capital and you can get the free cash flow to equity. You think, who cares? That's going to be the lock that allows me to decide whether I should do an equity valuation or a firm valuation. If I have a company where the debt ratio is stable and I don't expect it to change anytime in the near or far future, then equity valuation works fine because I can say the debt ratio for this company is 15%, I'm going to use 15% forever. You know how often that is the case? We look at a company and say, hey, I like the debt ratio, I don't think they're going to ever change. That's why I'm going to push you to the other option, because when debt ratios change, it's far easier to value the entire business than to value equity, and here's why. The cash flows of the firm are pre-debt cash flows. So I could change all the debt ratio as much as I want, the cash flow doesn't change. But what changes? The cost of capital will change because, so I will change the cost of capital debt ratio, and that's a much easier number to change than to change the cash flows. So I'm going to actually push you to value the entire business because it's a more general approach. It'll always work, whereas the equity approach requires assumptions about debt ratios staying stable over time. So here are the ingredients that ultimately will drive your value. The first is your cash flows, and those cash flows can either be before debt payments or after debt payments. The second is a growth rate, and the way you define cash flows will also determine your growth rate. If you decide to do things in equity terms, your growth rate has to be a growth rate in equity income, in net income, earnings per share. If you decide to do your cash flows to the entire firm, your growth rate has to be a growth rate in operating income. Sounds like you're playing games, but there can be a big difference. Growth in operating income and growth in net income can be very different numbers. In fact, some of you, when you sit down to value a company, will be tempted to go to Yahoo Finance and look up a growth rate for your company. You can actually, for many companies, there'll be a growth rate. What's a growth rate that you can usually find in services for your company? It'll say growth in earnings. What is it? Somebody? It's actually an analyst estimate of growth for your company. And you'll be tempted to use it. Why? Because he said, well, these guys work with these companies all the time. They must know more than I do. Fatal mistake, but it's easy to make it. But even if analysts know more than you do, here's the problem with using that growth rate. You know what earnings measure analysts focus the most on? It's not operating income. It's not net income. It's earnings per share. The growth rate you're getting is growth rate in earnings per share. 8%, 15%. If you use that growth rate as your growth rate in operating income, which is what you're doing in a firm valuation, you're almost guaranteed to overvalue the company. Think of why. Growth in net income, growth in earnings per share is going to be, for most US companies, much higher than growth in net income. Why? Because they do stock buybacks. Over the last 25 years, you saw that graph on stock buybacks. So when an analyst says the growth in earnings per share for Apple is 12%, the growth in net income will be only 9%. And the growth in net income will be usually higher than the growth in operating income. You know why? Because there's financial leverage. Interest expenses are fixed. And growth in operating income is going to be higher than growth in revenues because your fixed costs. So as you climb up an income statement, your growth rates will tend to get lower. So just because you find a growth rate online doesn't mean you should use that growth rate, because if you do, you've just turned over control of the most critical input in your valuation to somebody outside who might not be even talking about the same thing you want to talk about. So the growth rates have to be consistent with what you're trying to value. The discount rate can either be the cost of equity if you're focused on equity cash flows or cost of capital. And finally, as I said, at some point in time, you've got to assume your company will hit that stable growth. You're saying, how do I know that? We'll talk about choices you can make, what will drive whether you use 0 years, 5 years, 10 years, 15 or 20. But that's a choice you have to make. In doing all of this, recognize that you're dealing with the future, which means there are lots of things that are not in your control, that you're making the best estimates you can with the information you have right now. For some companies, it's going to be easier to estimate cash flows than others. Think about why. As you move through we've used the life cycle as our example to kind of talk about different scenarios, right? If I came to you with a company that is in the mature phase of its life cycle, a Microsoft, an IBM, a Procter & Gamble, a Coca-Cola, valuation becomes a lot easier, right? Because you can use history, you have margins, you know what business they're in, you know what products they produce. You can actually do just projecting, which is what a lot of valuation becomes. It's modeling. Basically, it's a spreadsheet with everything projected out. In which case, I really don't need you. If you think about it, if all I'm doing is projecting the past, what the heck are you doing in the middle? The spreadsheet can just read the past, project the future. Thank God you can't model every company's value, because if you can model all you need is one really good computer, one really good model, and everybody can be fired. Everybody can be outsourced. But if I came to you with Shake Shack or Box or Twitter, think of how much more difficult your job becomes. And be glad for that, because it effectively means that you have a reason for existing, at least in this valuation. Because now you have to make judgments like what? Like, will anybody ever click on a sponsored tweet? Ever? I've never clicked. Have any of you, in fact, let me do a show of hands. Have any of you ever clicked on a sponsored tweet? You have? Accidentally or by... You must be every social media company's dream. Why would you do something like that? Or they gave you a discount or something and they said, click it. Okay. Well, at least they said there's one person. This is Twitter's dream right there. If we all would do what he did, think of how much... Because that was the problem they ran into, because people are discovering when they advertise on Twitter that a lot of people are seeing that tweet, but nobody's coming to their... Which, of course, defeats the whole point of advertising. You want people to come to your site and buy stuff. So that's why Twitter's stock prices dropped 25% in the last earnings report, is they're discovering, at least advertisers are holding back, saying, this... You have a lot of users, 300 million users, but none of them seems to be visiting us. Right? But if you're valuing Twitter, that's the kind of judgment I'm asking you to make. Will that work? What kind of revenues? And it's going to be a lot more difficult valuing Twitter than it is to value Procter & Gamble. Right? But that's okay. You know why it's okay? Because it's not just you who's uncertain. Everybody is, including the people who run Twitter. So what makes you think you're special? That if you sit down with a spreadsheet, that uncertainty goes away? I could give you a Greek shipping company to value. I mean, that's a way to think about things. You know? It could be worse. I could be valuing a Ukrainian mining company, a Greek shipping company. All of a sudden, you feel a lot better about the company you're valuing. Say, thank God, I'm just valuing Twitter. Right? But you are trying to build up these numbers for the future. So what I'm going to do actually is take you through some of these inputs, piece by piece. And many of them, as I said, we've already dealt with. So there's going to be nothing here that you haven't seen before. So let's do the first up. You need cash flows. Those cash flows can either be to the firm or to equity. If you're doing cash flows to equity in the strictest sense of the word, you can say I'd look at only dividends. And there are some people who are purists who say this free cash flow to equity, I don't get it, the buybacks, I don't, but I'm going to focus just on dividends. That's the old Ben Graham security. If you read the old Ben Graham security analysis book, you are stuck with dividends because he says, look, if they don't pay dividends, you're not getting any cash flows. I think it's very rigid. But there are people who believe just in dividends. So that's the starting point. If you're a little more flexible and you looked at that graph we had on dividends and stock buybacks, you're going to say this is absurd. We can't just focus on dividends because a lot of companies supplement those dividends with buybacks. So I'm going to add buybacks to dividends and treat that as an augmented dividend. You see what I'm doing? Effectively, I'm saying it's all cash returned. I'm going to include both. But if you really want to measure what a company can afford to pay out, then you've got to go the long run and estimate the free cash flow to equity just like we did for dividend policy. So dividends, augmented dividends of free cash flow to equity, potential dividends, all cash flows to equity. All of them start with net income, right? Because it's an equity cash flow. In contrast, when I do free cash flow to the firm, rather than start with net income, I'm going to start with earnings before interest and taxes because I've got to climb the income statement. It's a pre-debt earnings. I've got to act like I paid taxes on operating income. In a few minutes, I'll explain why I say act like I paid taxes on operating income. And from that, I subtract out what I'm reinvesting, just like I did to get to free cash flow to equity. But here's the difference. If you compare free cash flow to equity to free cash flow to the firm, my starting point is different. After-tax operating income from net income. And I don't have that debt issued minus debt repaid when I do free cash flow to the firm because it's a pre-debt cash flow. So free cash flow to equity and free cash flow to the firm are separated only by debt payments. One is before debt payments, the other is after debt payments. So that's the first step, is estimating those cash flows. And of course, before you get ambitious about the future, might as well look at what happened last year. You don't have to be bound by what happened last year, but you need to know what happened last year. So that's what I did first. I started with Deutsche. And until 2007, 2008, as I said, I used to just take the dividends that banks paid and assume that that was their free cash flow to equity. Why? Because I was lazy. And I also assumed that banks were run by sensible people. Now that assumption is out of the window now. So since 2008, I've tried to estimate potential dividends for banks. And if you remember how we did this, we start with net income, but rather than subtract out net capex and change in working capital, which are kind of tough numbers to come up with for a bank, I'm going to take investments in regulatory capital as my measure of capex or of reinvestment. And to get the investment in regulatory capital for Deutsche, here's what I did. I took the Tier 1 capital ratio, which is the current number. I looked at the target they'd set for themselves, and they did this in their 10K of 18%, and I basically estimated how much regulatory capital they would need to have each year to get from where they are today to where they'd like to be. So there's my regulatory capital each year, and the change in regulatory capital, 95 million euros, is what I use as my equivalent of net capex. None of you is working with a financial services company, so you can estimate free cash flow to equity the conventional way with net capex and change in working capital. But if you really wanted to do corporate financial analysis for a bank, you have the tools to do it, but to do it you have to understand that regulatory framework in which banks operate. It's impossible to do corporate finance in a bank without understanding that regulatory framework. So my free cash flow to equity here is what they can afford to pay in dividends. So here's the contrast. If I valued Deutsche using the dividend discount model, I would be actually using the dividends they pay, and I'm trusting that that is the right amount to pay. And in fact, in my 2008 valuation of Deutsche, that's all I did, is I did the dividend discount model valuation of Deutsche. I threw up my hands and said, I can't estimate free cash flow to equity for Deutsche. This is my valuation of Deutsche. In the 2013 version, I no longer use a dividend discount model, partly because I don't trust the dividends being paid out by banks as cash that is available to be paid out. I'm going to use instead the free cash flow equity. And notice already something you can do with free cash flow equity that you cannot do with dividends. What's the lowest number you're going to have for dividends? Dividends can't go below 0. But free cash flow equity can be negative, which for a bank actually is something you have to allow for, because if you're an undercapitalized bank, guess what? Equity has to come into the bank for the bank to survive. So free cash flow equity, you get that freedom to allow for the fact that you might actually be below 0 for a while before you get above 0. And in this case, you can see that until I get to 2017, I really can't afford to pay dividends as Deutsche. And the more undercapitalized a bank is, the deeper the hole you're digging out of, the longer your negative free cash flow equity will exist. So that's dividends and free cash flow equity for Deutsche. For Tata Motors, I went back to a conventional measure of free cash flow equity. I started with net income, subtracted out net capex, capex minus depreciation, change in working capital, change in debt. Basically, if you take the net capex plus change in working capital, net of debt, I get what I call my equity reinvestment. Here's how to read it. In 2008, 2009, Tata Motors had minus 25 million or 25 billion rupees in net income. They had 62.2 billion in reinvestment that year. Their cash flow was actually a big negative number. The equity reinvestment rate, which is equity reinvestment divided by net income, was a huge negative number, because they were reinvesting even though they were losing money. Let's take a more reasonable year. Let's take 2011, 2012. They had a pretty good year. Net income was 135 billion rupees. Their equity reinvestment was 74.5 billion rupees, which means that they put back 74.5 billion rupees into the company. Why? As a stockholder in Tata Motors, this obviously reduces your cash flow when companies reinvest, right? But what's a quid pro quo you expect to get? You expect to get growth. And one of the things we're going to talk about is, I get less in cash flows when a company reinvests. But what I'm hoping and praying for is that reinvestment translates into higher growth in the future. Across the 5 years, here's what Tata Motors looks like. They had 330 billion rupees, good years and bad years put together, over the 5 years. They reinvested 87.7% of that money back into the company. Is it a good thing or a bad thing to reinvest a lot? Depends on where you reinvest, right? There's nothing inherently good about reinvestment. What if it's R&D? There's nothing inherently good about R&D either. This is a commercial enterprise. If you reinvest, I have a question to ask, and I'll come back and ask this of Tata Motors. I know you reinvest a lot, but do you reinvest well? So I've got half the equation nailed down. This is how much you reinvest. I still haven't looked at how well they're reinvested, and my growth is going to be driven by the answers to both questions. So in the case of Tata Motors, they made a fairly large amount of money over the last 5 years, but they reinvested most of it back into the company. Okay? Now for Disney, I'm actually going to go back to free cash flow to the firm. Okay? Remember this, I'm looking at pre-debt cash flow, so I look at operating income, and I do everything we talked about to get operating income nailed down, right? Leases have to be capitalized and adjusted for. So the operating income you're going to see for Disney of 10,032 million reflects my lease adjusted operating income. That's what I'm going to start with. But I have to compute that number after taxes. Now, if I have the operating income and I want to get to after-tax operating income, the natural thing that you might want to do is go get the taxes you paid out of the financial statements, which should be in the, either in the income statement or in the statement of cash flows, and subtract it from your operating income. Don't do that. Because here's what you're asking. If I had no debt, what would I have paid in taxes? You see why the answers are going to be different? Because if you have debt, you have interest expenses that lower your taxes. Act like you have no interest expenses. This cash flow that I'm going to compute is often called an unlevered cash flow. And the reason it's called an unlevered cash flow is the cash flow you would have had if you had no debt. So what I'm going to do is I'm going to start with the 10,032 million. I'm going to apply my effective tax rate, which is my average tax rate for that year, on that entire operating income. 31% of 10,032 million gives me about 3,100 million in taxes. If I look at what Disney actually paid in taxes, in 2012, it would have been a much smaller number. But that's okay because I'm computing almost a hypothetical tax. A tax I would have had to pay if I had no interest expenses. That's what the 31% of 10,032 million does. My after-tax operating income is 6.92 billion. Staying on the same statement of cash flows, and this is the advantage of doing valuation after you've done the dividend section, is you've already looked up these numbers for your dividend analysis, so you don't have to redo them again. My capex for the year was 5,239 million. My depreciation was 2,192 million. And in my capex, I'm going to include acquisitions as well. Do you see why? Why do I acquire the companies? Because I want to grow, right? That's fine. So I'm going to give you the benefits of growth from this acquisition, but I'm also going to count the cost of that acquisition as part of capex. You say, what if I don't want to count the cost of acquisitions? Then what should you do? What's the sense? If you want to take in this case, it's lowering my cash flow, right, by counting it. So I don't want to do that. It's too uncertain. It might never happen again. If you want to take acquisitions out of your capex, you know what else you have to do? You have to take the growth from the acquisitions out of your cash flows. Because if you leave one in and you take the other out, you know exactly what's going to happen. I saw people do this for GE for almost 20 years. Is they would take the growth in operating income of GE and use the historical growth rate, which was 8 or 9% between 1986 and 2006. And then they'd get to the capex and they'd include only the internal or the conventional capex. See how unfair this is? Because it basically means I'm giving you the benefits of growth from acquisitions and acting like it's costing you absolutely nothing. If you want the fruits of acquisitions as a higher growth rate, you have to pay for the trees that you need to plant to get those fruits, and that's what this acquisition in capex does. So my net capex of 3.629 million is what I'm putting into long-term assets. My change in working capital for the year was a tiny number, 103 million. I subtract those two numbers from the 6.92 billion. My free cash flow to the firm is 3,188 million. Now where does all this free cash flow go? So this is the cash flow after taxes and after reinvestment, right? So where are all the different places can go? What's the first thing I need to do from this cash flow? Pay interest and principal payments, right? Because this is pre-debt. So after I've done that, then I still have cash left over. Then what next? I can pay dividends. I can buy back stock. And what next? Whatever's left is left in the cash balance. Free cash flow to the firm doesn't mean just sitting around. It's doing lots of different things. But this is the cash available to pay debt holders, to pay equity investors, and to build up my cash balance. None of it is going to new projects. You know why? Because it's after capex and after working capital. It has to go into paying dividends, paying off debt, or it's got to go into an increase in the cash balance. So there's my free cash flow to the firm. My reinvestment, if you look at it during the year, net capex plus change in working capital is 3.73 billion. And as a percentage of my after-tax operating income of the 6.92 billion, it looks like Disney is reinvesting about 54% of its after-tax operating income back into the business. In what? Hong Kong Disney, ESPN expansion, movies like Frozen. I mean, all of those things are being taken. Again, I'm not saying it's good or bad, because to answer that, I've got to look at what kinds of investments Disney takes with that cash. So that's the first stop for your companies. Before you get too ambitious, look at last year. Look at what it made, look at what its cash flows are. Be open to the possibility that you could have a negative free cash flow to the firm last year. The word hasn't ended. Don't freak out yet. Because last year you could have reinvested a lot. You could have a negative free cash flow. Every single number is still your number to estimate for the future. This is just your starting point. Any questions on cash flows? Last piece for today. Let's talk about discount rates. And the reason I can do this, even though you guys look like you're zoned out, is you've seen it before. There are only two discount rates, cost of equity, cost of capital. Let's face it, this is the number we've spent so much time on in this class that at this point in time, you're either completely bored of it, or if you don't get it, then you're in big trouble anyway. So the rest of the class doesn't matter. So if you remember the way we define this, is the cost of equity is the rate of return you demand given the riskiness in the cash flows. I could ask you a fairly obvious question. Discount rate's a critical ingredient in discounted cash flow valuation. Obviously, it's called discounted cash flow valuation. Having said that though, I'll tell you what I feel. I feel we spend too much time on discount rates and valuation. and too little time on the cash flows. If you ever worked in a valuation and investment bank, here's how the breakdown of time is. 80% of your time is spent estimating discount rates. So what equity risk premium? Should we do this? Should we do that? What risk-free rate? Should we tweak this number? How about the third decimal point on the beta? Should we use this beta, that beta? Should we try this Bloomberg beta? And about 80% of the time in, you wake up to the fact that nothing above the line has been done. You don't have any earnings, no cash flows. So let's make up some numbers. So about 5% of the time is spent on the cash flows. The remaining 15% of the time is copying, making nice colored coded cells, etc., etc. We spend far too much time on discount rates and too little time on cash flows. So I'm going to lay out some general principles on discount rates that tie in very closely to how we've thought about discount rates all the way through this class. For my equity valuations, I need a cost of equity. There are only three numbers I need: a risk-free rate, a beta, and an equity risk premium. For my 2008 valuation, here's what I used for Deutsche, because I did a dividend discount model valuation. I used the risk-free rate then, which is about 4% in euros. I used a bottom-up beta for banks then, which is 1.16, and I used an equity risk premium then, which is only 4.5%. The cost of equity you're going to see in my original Deutsche 2008 valuation is 9.23%. Let's see what that number looks like today, or in November of 2013. The risk-free rate is 1.75%. Euro risk-free rate has dropped. The bottom-up beta now for banks is it's not that different, but 1.15 instead of 1.16. But the equity risk premium is 6.12%. Why? Because the equity risk premium across the board has risen, and I've factored in where Deutsche does its business. Latin America, Asia, all of that is entering in. The cost of equity you're going to get is 8.8%. You know what that number would look like today? That's November of 2013. The risk-free rate, instead of being 1.75% today, what's the euro risk-free rate? Somebody must be working with euros. What is it? 0.37%. So your risk-free rate has dropped, which means your cost of equity is going to be about 7% or 7.5% now. You're saying, this is horrible, I have to adjust the risk-free rate. Don't mess with it. It'll take care of itself. Risk-free rates are risk-free rates. It's not your job and my job to look and say, look, it's too low, let me fix it. It is what it is. And just thank God you're not working in Swiss francs. You know what the risk-free rate in Swiss francs is right now? Minus 0.2%. If you think 0.37% is freaky, think about using a risk-free rate that's negative and think how much more freaky it gets. But it's okay, that's what it is. And as I said, if you keep your valuation consistent, it's going to take care of itself, and you'll see how when we bring in the other pieces of the valuation. So that's my cost of equity that I'm going to use, the risk-free rate plus beta. It's the same cost of equity I used in corporate finance, now revisiting my valuation from the other side, from the outside in. To get the cost of equity for Tata Motors, I'll go through the process. I decided to do everything in rupees because I'm going to do a rupee valuation of Tata Motors. That's a choice I made. If I decided to do a dollar valuation of Tata Motors, I could have, the cost of equity would look very different. If you remember, the risk-free rate I got in rupees was 6.57%. It's way back in time. I don't expect you to remember it. But I start with the Indian government bond rate, and I netted out the default spread for India. That same 6.57% is the risk-free rate. The beta that I used was the beta for global automobile companies, the bottom-up beta. The equity risk premium for Tata Motors is not the Indian equity risk premium, it's a weighted average. Remember, Tata Motors' second biggest market is China. In fact, it's close to its biggest market. It's a weighted average of those numbers. So it's exactly the same. Cost of equity I used in capital budgeting, now revisiting the valuation as my discount rate for my cash flows. And here's the last number. I need a cost of capital. So this is, in fact, you might not remember, this is the fourth time I've shown you the same page. I showed it to you once when we did capital budgeting as the hurdle rate that Disney should use in deciding whether to do projects, right? It's a weighted average of the 11.6% in debt and the 88.4% equity. The cost of equity was a bottom-up, based on a bottom-up beta, a risk-free rate in US dollars, and an equity risk premium reflecting where Disney did its business. The cost of debt was based on the actual rating. That's a 7.81%. The same slide showed up at the start of the capital structure section. Why? Because I wanted to say, can I change this cost of capital by changing my debt ratio? And if you remember, what we concluded is based on the numbers, it looked like they could go to a 40% debt ratio And if they go to a 40% debt ratio, the cost of capital instead of being 7.81% would become 7.29%. In my valuation of Disney, I'm going to leave the cost of capital at 7.81%. Or put in valuation terms, I'm not using a target debt ratio to value Disney, I'm using its actual debt ratio. And here's why. It's not my company. I don't run Disney. So we might all agree in this room that the optimal debt ratio for Disney is 40%, but it doesn't matter. No? Bob Iger runs Disney. He likes 11.6%. As long as he runs Disney, that is going to be what I have to factor in. So the cost of capital I'm going to be using is a 7.81% to start the process. Know what I mean by start the process? I'm going to start projecting cash flows for the next 10 years, and I'll end with this slide. And as I go through time, I'm going to get a chance to revisit my cost of capital. Revisit in what sense? If I want to change the debt ratio over time, I can change it. If I want to change the beta over time because the business mix changes, I can reflect that. If I think the equity risk premium is going to change, I can do that. So at the start of next class, I want to talk about this process of adjusting cost of capital. But if you do get a chance, the spreadsheet that I have for the valuation actually does most of the stuff but you can change it if you want to change the default. So if you get a chance, try out the numbers for your company on that spreadsheet before Wednesday's class.
One thing is, my company is working on price line, and there's no easy way to estimate the growth rate, and it does a lot of acquisitions. So I was looking to understand a little bit of how do you estimate those, because otherwise the one way I could do it is exclude acquisitions from the capex, but most of the capex is acquisitive.
Acquisitions, right? What's the growth rate is like you average out the acquisitions over time and normalize them. And whether the investment, you still have to make an assumption of what kind of return on capital they earn, but the product of those numbers will drive the growth rate.
I see.
So let the growth rate be output rather than input.
Output, okay, I understand.
You be consistent at least with your assumptions then. Because it's like over-identifying an equation. If you set the growth rate, the reinvestment rate, and the return on capital, and they don't match up, then you're internally inconsistent valuation.
Right.
So pick two out of the three, and the third will come.
Sure. And one last question I had was, in terms of the WACC, is there a gigantic loop in the model because the WACC is determined essentially by the market value of the equity?
No, because that's the price at which you buy. Cost of capital reflects what you can buy the company at in the market today. The intrinsic value reflects what you think the company is worth. So when you go to buy the company, you don't pay intrinsic value. You pay the market price.
The market price.
The cost of capital is the cost of you acquiring the equity in the value of the company.
Okay.
The only scenario where you can think of that loop is when you're running a private business where there is no market price and you start with a number, then you can build in an iteration into your Excel spreadsheet where your estimated values of equity and debt can actually set your cost of capital.
I see. Thank you.
Hi. So basically, if it's different, you're going to trust the volume.
I'm doing this. They basically don't break out their revenue after a certain point. It's less than 10% of the company's total revenues. They don't do it unless it is other.
Oh, there are media,
Their
entertainment,
other
media,
is
electronics.
mostly like Amazon Web Services and like that kind of stuff.
The cloud. So it's the cloud services.
Yeah.
It's the electronics, which is the Kindle
Yeah.
and the Fire.
No, that's under something else because that makes up a larger percentage. That's broken out. So it's basically like media, electronics, and then everything else is bundled as other. And it's like Amazon Web Services and credit cards. Is it okay if just put that under?
Or put it into retail. Just add it on to retail because much of it is driven by the retail business.
Okay. And the last question I had was about the dividend section. I was looking to compare, I guess, the market IRR and dividend yields and adjust the adjusted IRR or the unadjusted version. Does that make sense? Oh, sorry, not
ROIC. Yeah, you're just comparing the ROIC to the market ROIC?
Yes.
Use the adjusted ROIC.
Use the adjusted one, okay, because it's like 20% different in case it ends up.
Because you capitalize sometimes.
Yeah.
Probably change.
Okay, great, thank you.
What are you comparing it to? When you're saying comparing it to, you're comparing it to ROIC you're computing for the other companies? Or
Yeah.
ROIC on my website?
On your website.
Because my ROIC is adjusted, that's why I said use
Okay.
adjusted. So if you're computing your ROIC yourself for the other companies, or using some service estimate, then you have to use the
No, this is
unadjusted.
using the ones that you gave
Then,
us.
then it's adjusted.
Great, thank you.
So it's pulling the paid services, right?
Yes,
Payment services have huge operating lines. So maybe Apple's cash could go operating cash. Because they're going to need some kind of back. They're going to
It's
need
at some
intraday.
point, there might be a regulatory overlay that comes with it as well, right? Because you can't be a credit card processing company without having that regulatory overlay. The question is, are they going to go the credit card route, or they're going to leave you with the credit card stuff and take the cash business away from you? You see what I'm saying? Like American Express.
Yeah.
It's not. It's really the payment processing that is the bulk of your money. It's not the interest you earn. Mastercard and Visa might have there's a banking model on top of the. So what Apple is going after, I think, is pure payment processing.
But MasterCard and Visa, I worked on those IPOs, and those guys have massive bank lines for the intraday. So they never end up at the end of the day with any borrowing.
Right.
But between 9 a.m. and 5 p.m.
Yeah, a chunk of the 170 billion. If they succeed in this, a chunk of the 170 billion will have to be set aside to kind of back up
To do
that
all.
business.
But at that point, does that then depress the valuation?
It'll take it out of the cash. The
Right.
question whether it depresses the valuation is what they get because of that cash, right? The payment processing will now create an income stream that is, given the size of the market, would be large enough. But right now they make almost no interest on the 30 billion, right?
Right.
So if they can generate a substantial income stream that
Yeah.
is predictable for that, it is a huge value creator potentially because they have the capital to essentially back up this business.
You know, back it up themselves without
Back
the
it up
use of the
themselves
bank.
without using a bank, exactly. You know, they have their own Apple bank in a sense internally, right? That they can use to capitalize it. So they have the resource. The question is whether they have the stomach, because it's a low margin, high volume business which doesn't fit into Apple's conventional high
A lot of
margin.
singles hitters.
Yeah, a lot of, and you really have to have that stomach for that kind of business, which is,
And that's a lower beta business than
it's
everything else there.
it is a lower beta business if it's just a pure pay. If they enter the credit card side, it's
Right.
a different business. When it's a pure payment processing, it is a low margin, low risk, high turnover business. And the question is, psychologically, will Apple be okay with it? Because, as I said, inertia is a big factor. If you're used to making 30% margin on your smartphones, when I start a new business with 2% margins, even on really huge revenues, people look at the 2% margins, which they shouldn't be.
Right.
Because you have to look at how much capital I've invested in the business, what do I make out of the business? But if you're focused just on margin, somebody internally is going to say, well, it's so much more